Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is Thursday. He's back from a conference last week in the great state of Texas. The one and only Mr. Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. I had a great time in Texas, meeting a lot of folks that, frankly, I knew online, even some good friends I know just from online that I've never met in person. So there were a whole bunch of people at the conference I got to see live. That was really great. And
That's awesome.
Picked up a lot of inside dope in the multifamily business, some of which I'll share with you folks today.
Awesome, buddy. Well, one of the things that I wanted to catch up with you on is I want to make a connection between a podcast that I listen to every weekend. Shout out to the folks that watch the All In podcast. Those group of individuals have been talking about the last 2 years in private company land, right? These are venture capitalists, anywhere from seed money to late stage. And they basically said the last 2 years was fueled by cocaine and Red Bull, basically highlighting that they made a bunch of mistakes. The whole industry made a bunch of mistakes. We saw Tiger down 50% because they tried to get in the game late and were paying stupid prices, 100 times revenue, just crazy valuations. And as I was listening to them riff on venture capital land, I keep going back to multifamily because I saw the same kind of behavior. Cocaine and Red Bull fuel, just crazy assumptions, just more and more money, more and more bad debt, more and more bad deal structures, crazy assumptions. And I'm like, you know what? For 2 years, the multifamily, my opinion, has been fueled by cocaine and Red Bull, and the party's over. So I don't know if that analogy carries water with you, but yeah, the last 2 years have not made sense. It was a great party if you got out, but if you're in now, I don't know. It's kind of late.
Yeah, the short answer is yes, I agree. The long answer though is a little bit more nuanced, right?
Mm-hmm.
But as these things all are. But listen, let's sort of like set what the landscape looks like. I mean, we were back at the end of 2019, right before COVID hit. We were already at an all-time high in terms of pricing and all-time lows in terms of cap rates.
Correct.
Nobody thought it could go any lower. Right, literally thought like it can't go lower than this in terms of cap rates, right? Mm-hmm. And then lo and behold, COVID hit, banks around the world dropped their interest rates to zero, pumped a ton of money out into the system, and a lot of that money found its way into assets, mm-hmm. and a lot of that money actually found its way into tenants' pockets, mm-hmm. to allow them to pay more rent, right?
Sure.
So. And there was a lot of movement too of people moving from high cost. As soon as they were able to work from home, they're like, hey, I'm leaving these high cost areas, going to a low cost area. And they were bidding up the rents in those areas because to them, what was expensive for the locals was cheap for them and they were happy to pay it.
Yeah. Exactly.
So you saw a lot of this going on, and all of that led to a situation in which pricing just got like seriously bubblicious in the last 2 years. I mean, it was like a frenzy of activity, right? And you could pretty much put out any asset for any price you wanted and get the price that you wanted because of all the money out there. Plus, there were people stirring the pot about inflation, right? And saying inflation's coming, you got to get protected by hard assets, right? Mm-hmm. So all of these factors contributed to this incredible spike in prices, as well as some really bad analytics or sort of bad mental models, right, that people constructed. But you always see this kind of thing happen during bubbles. Now, the last real estate bubble we had, you had serious people out there saying that the bubble could never burst because there was a shortage of housing and blah, 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 blah. And it will be this way forever. And it'll go up and up and up and up forever, into infinite future times. Right. Mm-hmm. And even though the math didn't make any sense, there's no way that property could continue to go up by 10 or 20% every single year forever. Right. Nobody would be able to afford it at some point.
Right.
But they said it nonetheless. This time around, what people were saying was, they weren't saying, well, this is going to go on forever, but they were saying things like interest rates will never go up. They'd pull out that chart from the 1960s and say, look, interest rates have gone down for 40 years.
They never come back. Yes.
It will never go back. Look, there's only one way that this can go. Right. And that was just sloppy thinking. Now, nobody saw that this, the same people who were saying inflation, 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 watch out for inflation. Not all of the same people, but many of the same people were saying you have to buy multifamily because of inflation. We're also mysteriously not saying, well, inflation usually leads to higher interest rates. The same people were saying inflation, 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 but low interest rates forever, right? So, as night follows the day, if you get too much inflation, you're going to get higher interest rates because that's the Fed's job. It's literally in their job description.
It's like job number one, stable prices.
That's right. Stable prices is in the Fed's mandate. That's their original mandate, even before unemployment became their mandate. It was stable prices was their mandate. So they were going to raise rates, even though everybody said that never going to happen. And here we are. And because of it, now we're seeing the bubble pricked. And one of the topics of discussion behind the scenes at this conference was that, look, we're seeing prices coming down. We're seeing deals falling out because they can't get the loan proceeds. They've probably gone down by about 10%, and they could fall more, but nobody really, was willing to speculate about how far they might go. People were also not calling it a crash, but they were saying, they were saying, look, the air is leaking out of the balloon, and the issue is like how much leaks out before it stops. Right? So,
because when I think about the analogy of a cocaine and Red Bull fueled party, it kind of feels like the same setup, right? Basically, there was a lot of positive momentum. Then the Fed and the government rains down money, so people are more flush. Gambling probably doesn't feel like gambling in the beginning. It feels like investing that turns into gambling, right? Just keep pushing money into the middle of the table. Then you start taking shortcuts. You start the herd really becomes a thing. And you don't do due diligence. Then you start getting bad deal structures and debt. And when it pops, there will be some deals that fall out, don't get done, which actually is safety. But in multifamily, as we've talked about for a year now, what I have seen is just deal structures that remind me of the '08 crash in residential. Short-term, variable, just wild ass assumptions. And that pain, in my opinion, hasn't started yet. So I'll call it a crash or an adjustment or a correction. Right. The 10% that we're kind of whispering about now, wait until the deals that are, technically they're not in default yet, right? They're in their 1 year or 2 years of IO bridge debt, but eventually they got to come back and the market is going to be different. Cap rates won't be 3.5. They'll be 6. Rents will be flat. Record occupancies won't be there. It'll go back to the normal. And it just feels like this party is going to have some very painful outcomes. And in VC land, we're seeing it down rounds. Instacart had a down round recently, more to come. I think multifamily won't feel it this year, but it'll feel it next year. So for me, it's like, well, that hangover's tomorrow. I don't know if that makes sense.
Yeah, I think we're just at the beginning of it, whatever. Right. So, I mean, if you start, the real key is going to be if you start seeing enough foreclosures to make bank sanctions. If you see that start to happen, then the banks are going to start pulling back. And if they start pulling back on lending for new acquisitions, that is when the market is really going to have,
Well, that's a question I'd love to ask you about. Let's poke at that a little bit more. My understanding in multifamily, and again, we're talking big, 100 units and above, potentially 10, 20, hundreds of millions of dollars. My opinion, and again, I could be way off, this is your area, not mine. A lot of those wouldn't go through foreclosures. They would use their loan terms or whatever it's called to just change the operator. No, or does it have to go through foreclosure to do that? I have no idea.
They may foreclose. Right?
Oh, they may foreclose. Okay.
Yeah, I mean, they would probably. I think it would if you start having trouble making your payments, or even if you just missed your covenants, you can still be making the payments. But if the bank, for some reason, is like not happy with how you're running the property, they can put you into special servicing, which is like kind of a more intensive like bank oversight of your property,
cash flow and all that. Yep.
Yeah, and they can, and then what'll happen is they may make it, try to make a determination as to whether the problem is you or the property, right? If it's you, then maybe they'll try to replace you with another operator. If they think property, then they're just going to cut bait and
Got
foreclose.
it. Okay. That makes sense.
So-
And again, just to kind of put on that, I actually think there's a third variable, right? There's the property, there's the operator. But I have seen historically, again, this time could be different. They may even start to identify cities or tertiary cities are like, that city's a problem. We're not any asset in that city, even with a good operator, we want to get rid of. I mean, that happened to me in Fresno 12 years ago, right? I had banks or loans I had to refi, and the bank that I used, who I never missed a payment with, was like, sorry, Michael, we love you. We'll give you an extra 90 days to refi, but we're not doing it because we don't lend in that market anymore. I mean, that could happen again too, no?
Yeah, I mean, because they do, Fannie and Freddie in particular definitely have guidelines as to where they want to lend and kind of assets they want to lend on, and they make those same calculations. And I think during the run up, they were getting a lot, looser. Right?
Of course, that's the party. That's cocaine and Red Bull taking over.
But I think also a lot of the looseness though was non-bank lenders, right?
Sure.
So, because Fannie and Freddie after a while had trouble competing because they were the cost of they weren't able to offer as much interest only debt, right? They were more debt constrained, right? With underwriting and stuff. So they stopped being competitive, and a lot of people started moving to bridge debt just because it was cheaper, and also because it was more flexible. Another problem, not problem, but another issue with multifamily lending is you really have to think about what your exit is.
Yes.
Planning on exiting in 3 to 5 years after you do a value add, your prepayment penalties on the Fannie and Freddie debt can be really, really massive. And even though that debt can be cheaper, or you can lock in fixed rate debt for a long time, there's a lot of attractive things about it. One of the onerous things about it is these prepayment penalties. And so a lot of people made the calculation that, well, hey, I'd rather have variable rate debt that's flexible for me to get out of when I want to sell or refinance, rather than, saddle myself with Fannie and Freddie debt. So there's a lot of different things you have to think about with the debt. But I don't think that the private lenders have a sort of strict like criteria as to like, we will do this city, we won't do this city. But I think the danger with private lenders is that they'll just dry up and go away.
Yeah, exactly.
Right?
Yeah.
Like they will just, those bridge lenders. I mean, people forget that, when COVID hit, bridge lending just stopped.
Yeah,
right?
there was a 75 or 90-day period where it just turned off. Even my flippers who were doing millions of dollars, they're like, nope, all done.
Yeah.
Loans are
those guys just like shut the doors and went on vacation for 3 months.
Yeah, right? They did. Yep.
And so, and it wasn't until the frenzy started that they all jumped back into business, right?
Correct.
But that can easily happen again, where
it will.
Let's go. Well, first of all, their sources of capital will dry up, right? They're borrowing money from the same place.
Absolutely.
And so they're in the spread business too, right? So they're borrowing money from capital markets, and then they're putting it to use in a mortgage, locking in a spread, and then that's how they make their money, right? But those sources will dry up, and it's so those are things that's what happens every time you have a big pullback, right? You have liquidity issues, and then you wind up with only the strongest surviving, and the weaker players are going to, weaker players who bought early will be fine because they'll have built in so much equity that they'll be okay.
Yeah, it's right? The last year is what I'm nervous.
The people who bought during this last two-year period, who were weaker players, those are the ones who may run into some issues trying to refinance, and you're going to have to do capital calls on their investors to make up the difference, and all sorts of stuff. So
yeah, I see a lot of it. Really, what I come from this Red Bull and cocaine party is there's a lot of pain to come in multifamily, the syndication. Just there was a lot of, the party was wonderful while it was raging. The party's over, and the hangover needs to be paid for now.
The flip side of this, though, is that means opportunity for people who are well financed, right? Who are well capitalized.
Exactly where I wanted to end. Yes, exactly. Yes.
I mean, the buying opportunity that everyone's been waiting for at least 5 years.
Right over there.
maybe on the horizon, right? If this does play out. Obviously, you never tell where things are going exactly, but I'd say that chances are better now than they have been any time in recent history that a buying opportunity is around the corner. So,
Yeah, absolutely. I see opportunity in multifamily. I may jump into, my biggest I bought so far was 20. I might be looking at a 50 or 60 unit, in the near future. It would be a nice to add, but yeah, again, you see it coming. I mean, I've been looking at my market, Jonathan, for 22 years now, and the prices that were being paid for the last 2 years never made sense. Now I get it. It was a cocaine and Red Bull fueled party. Now I know the come down from that's got to be nasty. And I'm just going to wait. It's like right over there. The dominoes are going. So it's going to be fun. Jonathan, where can people find you?
Yeah. So if you would like to join my investor list, you can Google Two Bridges Asset Management LLC and fill out the form that you'll find there. If you would like to join my free Facebook community, go to the Multifamily Investment Community on Facebook. And if you are interested in learning how to do this yourself, you can go to multifamilylaunchpad.org/join and join my program.
Folks, do yourself a favor, follow Jonathan, get involved with Jonathan. He and I have been talking for a couple of years now. He is that conservative investor, that mentor that I follow because I'm get excited what's coming. There's a lot of pain. This discussion about this party was not meant to scare you. It was meant to excite you because the opportunity lots of you have been looking for is coming. It's still around the corner, but it is coming. So do yourself a favor, invest, understand, learn. Don't just wait, take action. Join the Facebook group at a minimum. It is awesome. One more time, what's the Facebook group called?
The Multifamily Investment Community.
Awesome. I am in there and I look forward to it all the time. Thanks, buddy.
Yep. See ya.